Most people think that investing is all about picking the right stock, and they would be dead wrong. Investing is actually about having a system that you can implement to survive your own human nature, your fear, your greed, your impatience. The proof? Well, the average retail investor who's stock picking in 2024 underperformed the S&P 500 by 8.5%. That's billions of dollars left on the table because their emotions betrayed them. I'm the unintelligent investor, and today we're going to be breaking down the 6 key pillars of investing that I've compiled from the money managers who handle over $1 trillion in wealth. If you stick around until the end, the final pillar will help you understand that retail finally has the edge that levels the playing field with these institutional investors. Pillar number 1 is the foundation of the rest of the pillars, and it is passion. The legends of investing all say the same thing. If you're not genuinely obsessed, you're already losing. By day, I manage a cybersecurity incident response team. In that world, raw hard work simply isn't enough. I had to fall in love with understanding every new attack vector, every new adversary, every new trick. Without that curiosity, I wouldn't be able to withstand the high pressure situations that my job entails. Investing is identical to this. If you don't care, the second the price drops, you stop reading reports and you start doom scrolling on social media. Passion is what makes you outlearn and outinvest everyone who's just following a ticker symbol. I want to do a quick gut check for you guys. Take a look at your portfolio and ask yourself, do you love the positions that you have? If the answer is no, then you might not be investing and you might be more towards the side of gambling. Pillar 2. Failure. Even with passion, you will get punched in the mouth. In cybersecurity, we call that a breach. In the markets, we call that a loss. The winners don't fear losses, they dissect them. Every dollar you lose is your tuition. If you pay that money and just walk away, you're basically burning your money. But if you take the time to analyze what broke down in your thesis and how you let your emotions get the better of you, you'll take that loss and turn it into a lesson that'll make you way more money in the future. I opened up about one of my biggest losses ever in the first YouTube video that I ever made. I'll link it here, but ultimately the lesson is that I took those losses and turned it into a foundation of how do I invest now. That failure is the reason that my portfolio is stronger than it's ever been. Don't fear the drawdown. Fear never being tested, because ultimately the market rewards the students and not the quitters. Pillar 3 is having control over your emotions. We are all humans, and emotions can hit so hard sometimes, but the key to being a master investor is to be able to realize that you have these emotions and set them to the side so the logic can take over. Before I ever buy or sell a stock, I like to take a step back and ask myself whether I'm doing this because I have a thesis and it's the logical approach, or if I'm being emotional and, trying to FOMO into something or sell out of something because, everyone on social media says I should be scared right now. Ultimately, emotion is just a passenger. Logic is what should be driving your investment career. Mastering this will stop the average investor from making the behavioral mistakes that cause them to underperform the market. Pillar 4 is position sizing. High conviction is where the real wealth can be made in investing, but I am more on the conservative side, more towards the Warren Buffett style of investing. That being said, the most money I've ever made has been when I truly believe in a company and I take a bigger swing at it. Here's how I structure my investments, and I think this is something that most retail investors miss. You need to have 3 separate buckets, and these can be adjusted based on the stage of life that you are in. Bucket number 1 is your retirement account. For me, I auto contribute 12% of after-tax money to my Roth 401k. That money is in the S&P 500, is long-term, and I literally don't touch it. I set it and forget it. Bucket 2 is my core portfolio. These are my main positions, the companies that I've done deep research on and feel confident in their long-term trajectory. Bucket 3 is your risk capital. This is a much smaller piece of your overall investing portfolio, but it needs to be an amount of money that you're comfortable swinging big with. Chris CAMILLO has talked about the concept of a risk capital bucket beautifully. Comment below if you want to see a full breakdown on this concept. Ultimately, the key is to be patient. We have this bucket of dry powder sitting around, our risk capital, and then we need to find something that we're genuinely confident in to take that swing against. These plays can make great returns, but they can also go the other direction, and ultimately you can lose a large portion of it. So you need to properly allocate this and make that risk adjustment based on where you are in your life. Pillar 5, never invest in the present. The market is a discounting machine. It is already priced in the headlines of today. If you're buying based on what's happening right now, you're chasing the puck where it is and not where it's going to be. Ask yourself this: what problem is the company solving for that they'll be one of the only companies doing it in the next 5 years? Some other practical tips: read the forward-looking statements like the 10Ks, not just the headlines. Study the megatrends like AI infrastructure, renewable energy, battery storage, biotech, all of the main things that are moving us to the future. I want you to take just 30 minutes a week to sit back and think about where these companies will be in the future, so we can start predicting and stop reacting. Pillar 6, and this is the one that I teased at the beginning: become the centaur investor. Past generations would have killed for the tools that we have access to today. The greatest investors of the future isn't going to be a robot, and it isn't going to be a lone person. It's you, the human with the deep domain knowledge, the computer that can crunch millions of points of data, where you ultimately take your intuition and make the final call. AI ultimately gives you a superhuman data analytics power, summarizing 200 pages of an earnings transcript in seconds, spotting the sentiment shift over thousands of news articles, and backtesting ideas instantly. As a human, I think we have an irreplaceable edge where we have feelings and intuition about the market that an algorithm won't be able to feel. If you want more information on some of the ways that I use AI to help me invest, there's a link right here where you can check that out. Investing is not about being smarter than the market. It's about building a system that can survive the person that you see in the mirror. Passion keeps you in the game. Failure makes you dangerous. Emotional mastery keeps you in control. Smart position sizing multiplies your wins. Thinking 5 years ahead gives you the edge. And becoming the centaur investor is what allows retail to finally level the playing field. Which pillar did you like the most? Drop it in the comment and type CAMILLO if you want to see the deep dive on risk capital. If this video helped you see the game differently, smash that like button and subscribe. We are building the next generation of investors, one system at a time. Thank you for watching. I'll see you in the next one, and have a wonderful week.